Hello viewers, this is Dr. Alok Chajed once again and you are on Already Late, your favorite channel for updates and knowledge on personal finance and investing. If you have invested in liquid funds or other debt funds, you may have observed that the returns over the past few months have been very low. The returns, which used to be in the range of 5% to 7% per annum till about a year ago, have come down to almost half at around 3 to 4%. You may have been wondering why this is happening. In this short video, I will explain on why your debt funds, including liquid funds, are giving low returns, what lies ahead for these funds, and what should investors do with their investments in liquid funds. First of all, in case you do not know what liquid funds are and how they work, I suggest you watch my video explaining the same by clicking on this link. To understand the reasons for the returns going down, let us first see the journey of these returns over the last 12 months. Let me explain this with the help of a simple chart. The chart that you see on your screen now gives us the monthly returns of Axis Liquid Fund. I have taken this fund just as an example, and every liquid fund has a similar performance. Three things that stand out in this chart. First, a big dip in returns in the last week of March. If you remember, this was when India went into a lockdown, and due to the uncertainty, everyone from small investor to large institutions all wanted to withdraw money from everywhere. This caused increased selling in the markets, resulting in lower prices, and hence lower returns are seen during this period. The second thing that you see is a sharp rise in returns in the last week of April. This is because after a few days of lockdown, there was a sense of normalcy in the markets, and we all got used to lockdown restrictions. This resulted in markets coming back to normal. And because of lower prices in the last week of March, the returns 30 days later look high, because this is a chart of monthly returns. So anyone who invested in the last week of March in liquid fund actually earned excellent returns in the next 1 month period. Both these instances, the heavy selling and subsequent high returns, are extremely rare phenomenon in the markets. And as an investor, you cannot expect these to come across on a regular basis. The third thing in this chart is the gradual decline in returns in the months of May and June. This is where your returns started reducing and since then have remained in the same range. So what happened during this period? If you remember, there were a series of announcements by our Finance Minister Madam Nirmala Sitharaman and our RBI Governor Mr. Shaktikant Das. Among other things, these announcements primarily resulted in the government and RBI adding in a lot of money into the system through reduced bank rates and increased credit facilities to businesses. This resulted in a lot of money, in fact over 6 lakh crore rupees entering into the market. Banks and financial institutions were now flush with money. With too much money in the market and on the other side businesses still recovering from lockdown stress, the requirement for money was not there. It was at an all-time low. So when demand is low and supply is high for any product, the price of that product has to go down. The same is with money as well. Too much supply of money on one side and low demand on the other side resulted in interest rates going down, which in turn resulted in returns of all debt funds, including liquid funds, reducing. After June, there has been no additional money being pumped in by the government till now, and thus the returns are more or less in the same range over the last 6 months period. So the question is, what lies ahead? Will the returns go back to pre-COVID levels? Will they continue to be low? Should you move away from liquid funds now? Is there an option? Well, the lower returns are here to stay for a few months at least. There is an imbalance in demand and supply of money in the market, and it will take some time before consumption increases and the supply of money will also gradually reduce as we head back to complete normalcy. This might take a few months depending on the speed of vaccination, the rise in the number of COVID cases, and the overall sentiment on the ground. By the end of this year, we might see an increase in demand for money, and this will result in the returns on your liquid funds increasing once again. So should you move out of liquid funds? I would not advise you to move out of liquid funds for now. Remember, the main purpose of investing in liquid funds is to seek highest liquidity in case of an emergency. Presently, the returns might make you wonder if your money is better in savings bank account instead. But with money in savings account, the temptation to spend that money is higher. And moreover, as I said, this low return phase will pass soon. If you have money that you can set aside for a year or more, and do not want to take too much risk, you might want to look at floating rate funds. If you want to know about floating rate funds, stay tuned to this channel, because that is what my next video will be all about. It's all about floating rate funds and how the next couple of years floating rate funds should give you better returns than all other debt funds. So please do not forget to like, share and comment this on this video. And please do not forget to subscribe and click on the bell icon to stay updated. Thank you.